You know those classic investing books from legends like Peter Lynch and Benjamin Graham? They've literally made millions of people better investors. But here's a wild thought. What if some of their most famous lessons, the ones that became rules of thumb, are actually sabotaging your portfolio right now? Let's find out.
And look, this isn't just some crazy theory. This is a real, hard-earned lesson from decades of market evolution. It turns out some of the foundational ideas we all learned, the stuff that's practically gospel, they just don't hold up anymore. And sticking with them, well, that could be a really expensive mistake.
So here's what we're going to do in this explainer. We're going to tear down 5 famous investing principles. We'll kick things off with the outdated PEG ratio. Then we'll tackle the myth of a perfectly efficient market, expose the overtrading trap, and see why those old-school formulas just don't work anymore. And finally, we'll put all the pieces back together to build a playbook that actually works in today's world.
All right, first up, let's talk about the PEG ratio. This was made famous by the absolute legend Peter Lynch. His book, One Up on Wall Street, is just full of timeless gold. But one of its most famous tools, it's become dangerously outdated.
Now, let me be super clear. Lynch's core advice, it's as brilliant today as it ever was. Buying what you know, holding onto your winners, ignoring all the market noise, this stuff is the bedrock of great investing. But not every tool from back then has aged quite so well.
So, Lynch made the PEG ratio famous. It's basically the price-to-earnings ratio divided by a company's growth rate. Simple enough, right? And look, it was a genius shortcut to see if a stock's price was justified by its growth. But here's the giant catch. It was built for an economy where young companies had to make a profit early on. Today? Well, modern companies will pour every last dime back into growth, and they might not show any earnings or even show a loss for years and years.
And that right there leads to 3 fatal flaws. First off, it just completely breaks when you try to use it on modern, innovative companies. If you'd used the PEG ratio on a young Amazon or Salesforce, it would have been screaming at you to run away, right before they became some of the best investments of all time. Second, it's super easy to fudge with short-term accounting tricks. And maybe most importantly, it ignores what really matters, the quality of the business itself, its competitive advantages, its moat, and its real long-term potential.
So, what does this all mean for you? It means valuation is not a one-size-fits-all game. You can't just use one formula for everything. You've got to match the tool to the company's life stage. For those really early-stage companies, you should be looking at things like their total addressable market and price to sales. As they get to the middle stage, that's when forward-looking metrics become really important, and it's only when they're mature, late-stage companies that the classic PE ratios and dividend yields tell you the whole story.
Okay, next up, let's talk about the efficient market myth. This idea got huge thanks to the classic book, A Random Walk Down Wall Street. And honestly, it's a really big one to unlearn.
The theory itself, it sounds pretty plausible. The idea is that stock prices are always rational because they instantly absorb every piece of available information. Basically, it says you can't beat the market because everything's already perfectly priced in. But come on, if you've been paying any attention to the market lately, you've seen countless examples that show this is just not true.
You want proof? I mean, just look at the whole meme stock craziness. The level of irrationality was just off the charts. In less than a year, GameStop's value went from under $1 billion to $18 billion. And then it all came crashing down. Now, does that look like a rational market perfectly processing information? Or does that look like pure, raw human emotion running the show?
And hey, this wasn't some one-off thing. We saw the same thing happen with AMC Entertainment. Its valuation exploded to over $30 billion. We saw it with a tech company called Appian, where the stock quadrupled and then crashed right back down. And listen, this isn't just for small, crazy stocks. It happens to the giants too. In a single year, Google's market cap swung by $2 trillion. That's not perfect efficiency. That's fear and greed on an epic scale.
So here's a much better way to think about it. Markets are roughly efficient, maybe over the super long term. But in the short and medium term, they're driven by human emotions, and they are capable of making enormous errors. And you know what? Those errors, that's where the opportunity is.
All right, our third outdated idea, let's call it the overtrading trap. This is a concept that was really pushed by Jim Cramer. He calls it trading around a core position.
Now, on the surface, the theory sounds pretty smart, right? You hold a stock you really believe in for the long haul, but you sell a little bit when the price shoots up, and then you buy it back when the price dips. You're basically skimming a little profit off the top along the way. In theory, it should boost your returns. In practice, well, for most of us, it can be a total disaster. Here's why. It creates this really dangerous downward spiral. First, to even try this, you have to be glued to stock prices all day, which adds a ton of stress to your life. Second, all that buying and selling racks up transaction fees. Third, and this is a big one, every time you sell for a profit, you create a tax bill. That's a huge drag on your long-term returns. But honestly, the fourth point is the real killer, the massive risk of missing out on those huge, life-changing gains.
And that brings us to the biggest risk of them all. If you follow this strategy, you dramatically increase the chances that you'll sell a truly generational company, we're talking about an Apple, a Netflix, and Nvidia, way, way too early. The right move with those stocks, it was just to buy them and hold on for dear life. The amount of wealth that's been lost by people selling these winners too soon is just staggering.
Okay, Section 4. Let's talk about when investment formulas just plain fail. And for this, we have to talk about the godfather of value investing himself, Benjamin Graham. His book, The Intelligent Investor, is legendary. It gave us so many timeless ideas, but it also promoted a style of investing that really struggles in today's market.
So Graham was famous for what Warren Buffett later called cigar butt investing. The idea was to find a company that was trading for less than the value of its physical stuff, its factories, its machinery, its inventory. And look, that worked great back in the 30s and 40s when a company's value was something you could literally walk up and touch. But the whole economy has fundamentally changed. Today, the real value comes from the intangible stuff: software, patents, brand recognition.
And that's why that old formula of focusing on book value is so incredibly misleading today. Just think about a company like Microsoft for a second. Its true value isn't in its office buildings. It's in the Windows and Office software code and that incredibly powerful brand. And guess what? Almost none of that shows up properly on a traditional balance sheet. For most innovative companies today, obsessing over book value is just a completely meaningless exercise.
Okay, and that brings us to our final section, investing for today's world. We're going to tie all these threads together by looking at one last example. The famous magic formula from Joel Greenblatt's book, The Little Book That Beats the Market, which, by the way, is a fantastic book.
Now, let's be fair. For more than 20 years, this formula really was magic. It was a super simple mechanical way to find good companies at cheap prices. And as you can see, from 1988 to 2009, it didn't just beat the S&P 500, it crushed it. It worked like a charm.
But, and this is a huge but, here's the twist. When a simple formula gets that popular, it can become a victim of its own success. Basically, so many people started using it that all the easy opportunities just disappeared. And you can see it right here. Over the past decade, the magic formula has actually underperformed the market, and by a lot. It simply got too popular to keep working.
Okay, so let's put it all together. Let's take everything we've unlearned and build a new, modern playbook. Instead of relying on a single PEG ratio, we use a valuation approach that changes based on a company's life stage. We throw out the idea of a perfectly efficient market and accept that markets are driven by emotion. Instead of trying to trade around a core position, we buy great companies and hold on. We shift our focus from tangible assets to the intangible assets that really drive value today. And finally, we accept the hard truth. There is no single, simple magic formula that works forever.
And all this leads us to one final, really important question. Think about it. The ideas we just took apart were once considered gospel in the investing world. And that forces us to ask, what widely accepted investing truth that we all believe today will end up being the outdated myth of tomorrow? Because staying curious and always questioning the assumptions, well, that's the only timeless strategy there is.